Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF Conference. And I'm here with Dodd Kitsley, head of ETF strategy at Deutsche Asset Management. Great seeing you, Dodd.
Great to be here again.
As always, this is a dynamic conference. There's a lot going on. Last year, currency hedging was a huge topic at this time. Has that story changed at all over in 2016?
Not at all. In fact, I think currency hedging has really come of age and become much more mainstream. We saw massive growth with about 40% of all dollars going into international equities going in a currency hedged basis. We've seen a lot of innovation over the last year or so. The number of products went from 29 to over 80.
Wow.
Which was a massive growth.
Yeah.
And bottom line is clients now have an opportunity to choose among a lot of different strategies, markets, different levels of granularity to be able to eliminate the negative impacts both on return as well as risk that currency can have.
And from an economic standpoint, again, not changed that much. We finally had the Fed pull the trigger in December and the first rate hike in a while. So rate hikes mean stronger dollar?
Yes, and divergence in central bank policy is exactly what's going to be driving a stronger US dollar. We think dollar relative to the euro still is going to hit 95 cents by the end of 2016.
Wow.
Dollar still strong relative to the yen, albeit less so than euro, but trade-weighted dollar being stronger. And what we're going to see is a continuation for those that don't hedge, an erosion of returns from a otherwise good call on stock markets. We saw that in Eurozone as well.
Exactly. So currency moving the other way in developed nations, are they monetary policy? Do you think we'll continue to see loosening?
Yeah, absolutely. With the ECB and Draghi's most recent comments give every indication that they're going to continue to be accommodative. Same thing with Bank of Japan. They've got a big announcement later this week. We'll see, but all indications point to loosening monetary policy.
So coming down to the lowest common denominator is this. If you have foreign currency and you translate that back into US dollars and there's been an increase in the dollar and a devaluation in that local currency, that difference has that negative effect on that equity, is that right?
Absolutely, and it can have often in many years, and we think this could be the case in 2016, an even bigger impact than the risk and return contribution of the stocks.
Right. So with the Xtrackers, you have currency hedge products that basically cover the entire world.
We
right?
do. We launched 13 last year. We're up to 25, the broadest suite available of currency hedge solutions, ranging from the broadest exposure of ACWI US all the way down into specific countries like Germany, Brazil, Mexico, what have you. And we even have strategies now. Strategies like high dividend paying stocks in Eurozone, which we think is particularly attractive. A 5% yield, be able to eliminate and reduce volatility down by 30% and still get broad exposure to the Eurozone.
Great. Dodd, as always, we appreciate the time and education.
Thank you very much, Tom.
Thank you.